This is Archna. This is my website, ArchnaTrades.com. I run Twitter Trade Alert subscription and one-on-one mentoring service. So I'll get right to it. If we look at it over here, I am not giving any professional advice or anything that you should take away from here is that trading is risky and you are your own boss, which means you make your own decisions. I'm here only to give some information about me and how I trade. So let's talk about me. I trade for a living and support clients who do the same, who want to do the same. I have been a tutor, math tutor. I still tutor math. That's one of my hobbies. I can't let go of that. So I like teaching. So I started doing this trader education by doing one-on-one. When I tutor kids math, the fractions may be the same, but how I have to teach one person is different from how the other kid understands. So it's going to be different techniques for different kids. And so trading cannot be a one size fits all course, in my opinion. So I thought it is better to do one-on-one mentoring rather than just offering courses, online courses and charge little, but get nothing out of it. That's my opinion. And after doing trading, after doing tutoring and all that stuff, all it comes down to risk management for me. People you will hear on Twitter say, oh, I made so much or I lost so much. Majority of the times, everybody is posting only their winning trades. Nobody posts their losing trades. So you're looking at people talking about making money. Nobody talks about keeping the money, right? You can make $2,000 one day and lose $4,000 the next day, then what's the point? You did not keep the money that you made. So risk management being the biggest focus of me, because when you are making a living, you need to be able to sustain yourself. Today, the market is not good, doesn't matter. You have to be able to take out some salary or something for yourself if you are saying that you're making a living. So I focus a lot on risk management. And that's why when I started off as a technical trader, then went through phases, losing little money. And then, oh, if I had just put a stop little bit wider, I would have not lost the money. Gone through all that, learned again delta neutral trading, where you don't even look at charts and everything is based on option Greeks. You do calendars and strangles and everything, just looking at the volatility. And then I decided to merge the two and make something of my own. And so my philosophy is, okay, why unlearn the technical charts that I learned? Why unlearn the delta neutral strategies that I learned? Why not merge them together and make something that is low risk and able to generate profits for me? So, everybody talks about options are very difficult. For me, yeah, they are. But if you know the Greeks, right, options have Greeks. So if they have Greeks, let's take advantage of them. I firmly believe that I should use all tools available so that I risk the least amount of capital. If I put only $100 in the market, that's the only thing that I can lose. They cannot take 2,000 from me. So I firmly believe in low risk, which means low debit strategies from my end. I have combined my technical analysis and options Greek knowledge to have high probability of success trades. So I'll be teaching today calendar spreads. They are also called as time spreads or horizontal spreads. This is a low risk strategy, which is mainly a low volatility strategy. So for these last few days, of course, you cannot do a low volatility strategy while the market is going down, but it just profits based on passage of time. Whatever, all the options that expire out of the money, they expire worthless. So I am taking that concept. If you know the statistics that 85% of all option premium go poof, they expire worthless. I am just using that component and using my technical analysis to do calendar spreads. So this strategy requires you to buy one option and sell one option of the same type. So if you're buying calls, it's going to be buy a call and sell a call, or put, so it's going to be a put, same strike price, but different expiration cycles. So you're selling a near dated option, buying a longer dated option of the same strike and same type. Now, because the later dated option decays slowly, it has more time. Suppose I give you, okay, I give one son $100 and I tell that you have to spend it in 1 week. And if I give my another son $100 and I tell him that he needs to spend it in 1 month, how much is my son, who has more than a month, almost a month to spend? He's going to spend money every day. He's going to spend less money compared to the son that I told that he needs to spend $100 in, say, 1 week. So that is what I'm looking at. The theta, or the time decay that each option has, is going to be different. If that option has an extrinsic value premium, say $200, okay, for April expiration. So you're talking about it has to take the $200 slowly out and make it zero if it's out of the money, right? We're talking about out of the money option. So slowly it has to decay that over 60 days, because April is around 60 days away. Whereas if you're talking about March, it has only 15 days. So in 15 days, it has to take that $200 off. So it decays faster. So that concept of time decay is what I am using over here to take advantage of. So I will sell a near dated call, which will decay faster. I will buy a longer dated option, which will decay slower. Okay. This gives me more time to be correct. I don't, today, if I see a chart and I say, oh, Starbucks is going to go, I don't have to be right away, because I'm giving myself time. Why am I giving time? I'm buying a longer dated option. So I have more time, but then it's going to still decay, right? So I'll sell something against it so that I will not have to spend a lot of money. Okay. I don't like spending money. So that's what I look for even in trades. So the assumption here is that you are expecting the stock to be in a range for a while, okay, or at least for near term. Why near term? It has to be in range. If the stock is going up and you sold the call, you are going to be in loss, and the loss will increase faster. So that is the reason you're looking at some kind of a range in the near term, and then most likely a breakout. Yes. So that is the reason I'm saying that I do directional calendars, not delta neutral calendars. So when I learned it that it is a decay of time decay of options is what it takes advantage of. And it profits because the option that I sold decays faster, expires worthless, and I'm left with something that already holds more value because it has still more time. And you can make money that way. So it's a low implied volatility, neutral bias in the short term kind of a trade. So let's see how the setup works. Okay, this was done on Sunday. So Starbucks current price was at 108. So I decided to sell March 19, 110 call, buy April 16, 110 call. So you can see over here, the red is showing that I'm selling, the green is that I'm buying. So it is in different expiration, 110 call for March, 110 call for April. So you're talking about the same type, the same strike, different expiration. That is the reason it is called a horizontal strike. Like that. It is called a horizontal spread. You can see if you plot it on an XY axis where days of expiration is there, you are selling in the near term, buying in the further month, and it becomes a horizontal spread. Now, why do I do these things? Look at it. If I just bought the April 110 calls, I would be paying $3.65. If I sell the 110 call along with it, I got a credit of $2.10. So I am only risking $1.55. So, I have reduced the burden on me by putting a smaller debit. Let me explain. So if I bought an option for $3.65, the max I can lose is $3.65, which means I need to be correct. And at that time, Starbucks was at 108. My break even is going to be the debit that I paid, which is $3.65, which means 108 plus $3.65, 111.65 is my break even for April expiration. If every day that Starbucks does not move in my direction, the $3.65 debit that I have paid is going to start decaying, which means I want to be correct right away. With choppy markets, or when it has not yet broken out with a clear trend, that may not be suitable. So when I'm selling something against it, I am giving myself cushion because I am paying smaller debit, which means my break even is smaller. And I'm expecting it that it will, the 110 call will expire worthless. And then I'll be left with the April 365, okay, which was only going to be worth 155 because I paid that, right? My break even now is only 109.55. By April, if it is above 109.55, I'll make money. So I have reduced my cost basis. I have risked less money. When you risk less money, I don't need to put a stop. I'm fine. If I have a debit of $3.65, I'm looking at the chart. Oh, if it goes below 107 or something, I'm wrong, or probably I will lose too much premium, I'll put in a stop. So you would hear that there were people who would take an option trade, put a 50% stop, right? So if $3.65 is your debit, you would put a stop at around, say, $1.80, which means you're willing to lose $1.80. Me doing a calendar, I have paid only $1.55. So I am risking less than what many people risk. So I don't have to put in a stop, okay? So that's how I am doing it. And this is the risk graph of the this trade, which means it was at 108. I am buying 110 calls, which is little further out. So I am making it more directional because I am expecting it to go higher. And then these two red lines and where I've put the arrows, that is my break even, in the sense, not break even, it has to be in range. So Starbucks, as long as it is between 104 and 115, I don't have to worry about it. The time decay is going to give me some profit. And then in March, if it expires, the 110 call that I sold, if that expires worthless, then I am left with my 110 call to do its directional thing. Okay, so I don't have to be right away. It can go down, I can still be profitable. It can go up, I can still be profitable. So, I'm taking advantage of the option Greeks to lower my risk. That's what I'll say. Okay, what happens if it goes below 104 or it goes above 115? The calendar would be a loser. Okay, the only thing calendar hates is fast moves. If it is slowly fading away, I will still make money because I said what? The one that I have sold loses premium faster. So even if it goes down, even if Starbucks goes down, okay, the credit that I got for selling the 110 will become profitable faster than the debit that I paid for 300 for the 110 call of April that I bought. Okay, that would be lower. So I would still be making money. If it goes up, yeah, I'll start losing on my 110 call that I sold in March, but the 110 call in April that I bought, that will make money faster. That will make money. So I would still be making money. Yeah, if it blows through 115 or goes below 104, my calendar will be a loser. But the max I can lose is $1.55 that I paid, not $3.65. Okay, there are ways to adjust a calendar and salvage it, but I don't do them. Okay, because I am making it directional. I am putting my opinion, and I've reduced the cost basis to an extent that I don't want to manage it anymore. Okay, no stop, nothing, expectation. I put the trades expecting that either it makes money or it makes money because it's in the range. Then I take small profits. It makes huge amount of money because my direction worked after the call that I sold expires, worthless. Okay, so I'll give you an example after we go through all the Greeks. Okay, so I was explaining you that passage of time and it goes faster. Let me prove it to you. Okay, so theta is the time decay. The March time decay as shown over here, okay, for the option that I'm selling is 7 cents, which means $7. The April theta or the time decay is 5 cents, which is $5. So every day that Starbucks is in the range, only due to time decay, my spread, okay, my trade is making $2 in time decay. Okay, it may not seem like much, $2, but it gets when your direction along with, so if you just did this trade as a delta neutral strategy, yes, it's low risk, low profit kind of trade. Whereas merging it with technical analysis, it can work wonders, is what I am able to do. I'll show you how. Okay, so this is still, it is also called a trade where if it increases in volatility, the market, it will help. So let's go through it. March has less time, which means it has less extrinsic value left. So the option price increase is less, okay? Even though the volatility may rise, there's not much left for it to rise, okay? Because it's so much out of the money that even if the volatility rises, the increase that can happen because the extrinsic value left is very little, that it won't work. Whereas April has more time, which means it has more extrinsic value. So with volatility increasing, the option holds more of its premium, and hence its calendar is also called a low volatility, and it benefits from increase in IV. So how do you select the strike? Okay, the time spread or theta differential is the widest at the money. So we are looking at closer to the money. If I have to do a delta neutral range bound thesis calendar, then you're choosing at the money closest call or at the money closest put. Okay. Now, there are two types of calendars that I do, and that is suited for my kind of trading, is directional calendar and earning setup calendar. For both forms, I rely on technical charts for strike selection and expiration selection. So let's go through this. I did this trade last year. I've done many calendars last year. I'll go one of it. I'll do one here. Directional calendar. So this was the Spotify chart. I'm looking at it over here that this is almost like an inverse head and shoulders about to break out, right? Now you know that it is already broken out, but this is where I was looking at it. I have put the arrow and I'm like, okay, every time it comes at around this 285, it goes down, right? We technical traders, that is horizontal resistance, you would probably be a person selling there. I'm like, but it is done once, twice, thrice. It should break out, but I don't want to wait until it breaks out and be late. I don't want to be too early and lose money. So what I do is I make a calendar. So this chart is an actual trade that I took. Okay, it has not broken out. So I selected on this day, which was 11/5, I think 11/5 or 11/9. Okay, it was on 11/9. It was showing a wick, which means it is going to do again the same thing. So what I did at highs, I bought a two. It was at 280, 285. I bought a $300 call calendar. I sold the 11/20 expiration because it was so close and the IV was high that I was able to sell. It was at 280. I sold a $300 call calendar. For 11/20 expiration, I sold and I bought December 11 expiration. So ideally, I'm looking to sell anywhere from 14 days to expiration. This DTE means days to expiration. So I'm looking at close to 14 days to expiration is where I will sell. And I will double up the expiration time for the option that I'm buying. So maybe around 28 days or something like that is what I'm looking at. That is ideal. So what I did was I paid $4.28 for this $300 calendar. The $300 calendar 11/20 expired worthless. You saw that it was always, it usually goes down. So it expired worthless, okay? And then it broke out. So by December 4th, okay, Spotify was at $318 and my December 11th option was at $21. So I took it from $4.28 to $21, which was a nice profit. But you should ask me questions. Why did I get in early? Why did I not wait for spot to break out, right? Why was I willing to go through all this downturn? I should have just waited here and bought it, right? So my answer to that is I like to be a little early because again, I don't like to spend a lot of money. So what I'm doing, okay, I am anticipating that the inverse head and shoulders is going to break out. So why not leg in, right? So trying to leg in is my strategy here. Yeah, last year was very bullish. Okay, I'm not going to be doing this kind of in this choppy market. I'm not trying to get this 4 to 21 kind of a trade anymore because we are not having those kind of moves. Last year, we were having those kind of moves. Anything that seemed like it's going to break out, broke out. Okay, so I'm looking at the market conditions to decide that. So I did not mind being early because that is what the market was offering last year. And before anybody could get in, I wanted to be early so that the premium had not yet increased. Because when my stock has big moves, the premium increases pretty fast. and I don't want to pay a lot of money. So I'm taking a chance here that it may not work. Okay. Yes, that makes the chance of it not working higher. But what I'm doing it, instead of just buying the December call that I'm expecting the breakout to happen, I am selling against it, right? So I am reducing my cost basis. I am reducing my risk, even though I got in early. So on 11/9, when I did this trade, the December 11th Spotify 300 calls were almost bid at $7. So I was not planning to put $7 at risk. So to have less risk, what I did was sell this 11/20 300 call and made it a calendar and risked only $4.20. So the bid ask spread over there for December 11th was 7/8, right? So I would have almost, if I bought the option, only December option, I would have spent $8 and then probably put a 50% stop loss at $4, which probably, because of the move that it had down, I would get stopped out rather than going through this and then, oh yeah, it again, get in again, because I don't want to do multiple trades. I would rather expect, yeah, this is what I'm expecting, lean into it, risk small. So instead of risking $7 or $8 and putting a 50% stop and getting stopped out at $4, I risk only $4 by making it a calendar. Okay, so calendar profits from passage of time, right? But what happens if it moves up or down in any direction fast enough? I told you I lose money. There are ways to manage it. I could sell something in the one that has already, I sold the 300 call. And if Spotify goes to 250, not only my 300 December call, but my 300 November is also losing money. So I could roll it down and make it a 290. I could sell a 290, but that would require a margin trade. I don't do all that. Calendar trades are a directional trade for me, is the way I constitute it. And it's just a risk mitigation strategy for me. So then I told you that I don't adjust. Instead of buying expensive options and then putting a stop, I just sell something against it. And I was able to make money with that trade. The second type of trade is the earnings setup calendar. And I try to make it free. Now, yes, you should get the thesis. I like to spend less money and I like to trade free. How do I do that? So usually a stock does its pre-earning run 14 to 21 days before, right? 7 to 14 days. 2 weeks before a stock's earning, they usually run. So what I would do is I would get in earlier than 14 days because the premium has not yet gotten. The IV has not yet started increasing. People are not yet looking at it. So I would go ahead and buy a 21-day expiration call. Again, to reduce my cost basis, I would sell against it, okay, 7 DTE, 7 days to expiration. That would expire worthless. Again, sell something 14-day DTE, make that expire worthless. And then I'm left with the call on that includes the earnings, which means that it has risen in IV. And if it has already gone up a little bit, then I would probably be in the money, or the premium would have increased so much that I can sell something against it in the same expiration to make it a free call spread. And that's how I have traded last year TRUP and Chewy. And I did a couple of more, but TRUP, actually, I did it in the trading room when I used to work with Samantha in Laduk Trading. This was a live trade that I did. So it was in, I think, June or July. I bought a $50 call calendar, wrote it such every week sell against that $50 call. And then before earnings made it a 50-55 call spread, which was already profitable because I had already sold more against it, that it was profitable before that. And I sold 55 calls and got a credit more than the cost of the 50 calls. So it was profitable before it was free. And then I made it free, and TRUP closed beyond, I think it closed beyond 60 after earnings. And so I made $5 on a trade which was free. So that's why I'm saying option Greeks, if you know, you can take advantage of it and use it clever. So this is the setup, what I'm looking at it. As I already told, 7 to 14 days, IV has not yet risen. And yeah, this year it has not worked because none of the trades, earnings, they've not had pre-earning runs, and majority of the earnings reaction has been down. So this year, this won't work, okay? That was last year. So I modify it. This year, I haven't done much of earnings setup trades. I tried it in Zoom. Yeah, I tried it in Zoom. It did not work. I tried it in, yeah, I did not try. I tried it in Twilio. That also, not something that I can boast about. So this year, earnings setup calendar has not yet been working. Now, finally, I'll say that, technical patterns. I can understand technical patterns, but the market can choose whatever it wants to do, right? I may be, oh, it should break out, but it is not. The market can decide to do whatever it wants. So the biggest rule that I follow is live to trade another day. For me, how I look at that is reducing risk by putting less in the market. If I put in less, I can't lose more. Reducing cost basis of whatever I have. So even if I have stock, I'll sell something against it. If I have leaps, I'll sell something against it. So always my focus is putting in less money in the market. So last year in the trending market, directional and earnings call calendars helped me a lot. This year with choppy to down market, most of the breakouts are failing. Buying calendars have helped me in the sense that I have not risked more and lost more. I've risked less and certain trades have not worked out. So that's all I can say about calendars. I like them. I'll just say something about me. This is my website, archnatrades.com. I run Twitter Trade Alert subscription and one-on-one mentoring. Currently, for anybody who's attending here can get a 1-month free trial to the Twitter Trade Alerts. That's it. Any questions if you have, you can ask me. Otherwise, I'm done. Thank you.
Did you see the earnings in the the questions in the chat?
No, I haven't.
Okay. Stephanie asks, can you recommend some best books for learning Greeks?
Books for Greeks. I took mentoring from somebody. I have not read books on Greeks, but yeah, Tasty Trades is the best resource as of now. If you're talking about free Greeks, they advocate more of selling. But yes, understanding of Greeks, you can understand there and then incorporate the way I incorporated. Yes, I do call diagonal spreads. Of course, I do call diagonal spreads. The only reason calendars worked last year. So the way I used the calendars was, especially with the market, the way it was running last year, right? You would see it would run 10% one day. So the IV and the premium on the weeklies would have risen so much that I wanted to sell something against it. So I would sell the weekly and buy the next week or the week after, because I'm still expecting it to go up, but you can't have 20% moves or 10% moves every day. So I would sell the weekly, get something and buy 2 weeks out. Last year, diagonals versus calendar. So for diagonals, I don't do margin trades. I always look at, with choppy markets, diagonals difficult because you are, yeah, with choppy markets, calendars are better because you are trying to go in the close to money. Whereas in diagonals, you will not get much. If you're trying to sell something way out, you won't get much premium. So yeah, put diagonals also I buy. I have bought put diagonals. The only reason put diagonals last year, what will you do with put diagonals? Nothing. Double calendar, no. I don't do those income strategies for double diagonals and double calendars. The commissions now are cheaper, but before, if you're looking at it, I'm putting 4 different legs. I want it to be in range, and then making 10% on the trade did not suit me. It just did not suit me. Uh, so put calendars also are fine. This year, actually, put calendars would work better compared to last year because we've had choppy to down markets. So with IV expansion, put calendars for this year would be a better choice if you're looking at doing income type strategies. So your favorite call calendar for earnings. So I told you the best time, if you are bullish a stock, and if you go through, so what I did was I would go through on Thinkorswim. If you go to Analyze tab and go to earnings, you can actually see, maybe I can show you. Yeah, okay. So if you look over here, if you go to Analyze and Earnings, you can see what the stock, right now it's Baba over here. So you can see what Baba did on earnings and before it. So I would look 21 days or 30 days before. I would start looking at this. What was the general trend of the stock, right? If Zoom, last few times, what it has done, it has gapped up. Netflix usually gaps down on earnings, but it does have a pre-earnings run. So those kind of things, I will look at it. I will go to that earnings page on that and see what the last 4 earnings the stock has done. If it is usually gap up with pre-earnings run, then 21 days before the run has actually started, I will configure a calendar. So 21 days before the earnings, it has to include, the one that I buy has to include the earnings. So if it is like DocuSign, I think, has next week earnings, right? What is the website for earnings? No, I'm looking at Thinkorswim only. What it does. Yes, I will hold it through earnings. If I am bullish, so like, suppose I'm just giving a hypothetical example and I don't know whether it works. This is all educational information anyways. So if DocuSign is next week earnings, if the market was not this choppy, what I would have done, it has next week earnings, it has. So instead of buying a 312 expiration, I would buy a 319 expiration, but 2 weeks before, which means last week of February. Okay, I would sell something in last week of February, buy something in 319 expiration, which is the options expiration, make it a call calendar, buy the call that far out. So let me see if I can probably look at it and set up a trade. Can you tell me any other, because DocuSign is totally broken. So I am going to do an assumption. Okay, let's just do an assumption because that was on my mind. So if DocuSign were somewhere here at around 250, earnings is next week. It is in a consolidation where it can break out of 275. Okay, on earnings, it is, if it wants to test its highs. Okay, all these are ifs and buts. So I don't know the right setup. I'm just coming up with a thing that I look at. I would go on here, analyze. I would go on this earnings page, look at it, what it has done in the previous earnings, what it did. Okay, it gapped up on earnings, but before its earnings, it was, it didn't have its pre-earnings run. What did it do here? It gapped up. It did not have its pre-earnings run. So then I'll come up, okay, this is not a good candidate for doing this kind of a trade. Okay, so, but if it was looking here, okay, it usually runs up, gaps up, usually runs up, gaps up. Out of the 5 here, I'm looking at 3 times it's done that. Okay, so probability is in my favor. Okay, 3 out of 5, it does a pre-earning run, gaps up. So why not have a trade? Plus it is around at a breakout point where it could go up. Okay, earning trades are 50-50 anyways. I am just trying to put many aspects in my favor. So it does a pre-earning run, my favor. It gaps up, earning run, fine. So let's do that. It's close to a breakout point. Let's do that. And then, okay, if unless and until it gaps over 290, it may not run, it may fade. So let me do a 300, okay, $300 call calendar. I would buy somewhere, okay, if it was over here, around 216 is when I would schedule, I would make the calendar, sell something over here, okay, weekly, but buy the 319, 300 call. I would have lost money while it is going down here. Okay, this is not the right test case. I'm just putting it out there. Okay, if it goes up slowly, that's fine. I'll make some money. If the stock that the call that I sold expires worthless and I'm close to 300, then I will sell, say 310 or 320. You're talking about it over here. Here, analyze earnings. This is where I can see last 5 earnings, what it did. Is that okay? So it tells you, it shows not only the implied volatility, okay, it is showing you the straddle, how much it was, whether it is expanding or not, and what the price action did. I can see all 3 in a snapshot. So that helps me decide whether it's a good candidate or no. I don't do a lot of these, but when I do, I am looking at, okay, 3 out of 5. IV was fine. It has not yet risen. You look at it over here. It tells you, okay, the implied volatility is higher already, right? Here it is not yet. So then those things, okay, even though option Greeks are mathematical, it's nothing mathematical here. You have to just train yourself, try it. But by making it a calendar, I'm not risking a lot anyways. I'm putting less money than a simple call. Yes, there are times when it runs very quickly and I could have made more only having a call. But there are times when, like right now, I had GM, right? GM over here was breaking out over here, right? Almost breaking out. So again, I have a $60 call calendar. April $60, March $60. That's what I did. Because here I am now not losing money while the market is going down. GM is again consolidating. I'm not losing money. Otherwise, if you just look at the chart, yes, it's almost about to break out. Why should I not buy a call? But the market had been choppy. So why would I just buy a call and risk more? Why not sell something against it so that I'm still placing the bet. I am still looking at the chart, placing the bet, just putting in less money. So then I don't have to stop myself out very often. That's what I'm doing. And so it works directionally. And then earning setup calendars last year, Trupp, Chewy, I was able to do it for Zoom. Many of them worked. Start off as a calendar and then sell a call over it to make it a vertical spread, which was free. It doesn't usually happen all the time. So that's why I did not emphasize a lot, because earnings anyways, sometimes the run happens so much there. Around a year or two ago, yeah, last year Netflix, I think it ran so much that the calendar would have not worked. Calendar would have lost money because it ran up too quick. So you're taking probabilities, just looking at this over here. I am making an educated what can happen, and whether I'm comfortable putting it out there. That's it. But double calendars and double diagonals, the income type things, I don't do it. I was not able to unlearn my technical analysis to get into doing those. I hope I'm clear. Okay. Any more questions? Thank you.